Brad Williams, Frugal Finance. Here's a video on trying to clarify an area that is a bit confusing, and that is over-the-counter equities trading. What does that mean? What are all the different types of trading? I'm not going to get into anything more than OTC right now because there are a lot of different moving parts when it comes to investing. But this topic will be over-the-counter equities trading. What are all the pieces? When it comes to equities trading, movements of share prices on major stock exchanges like the New York Stock Exchange and Nasdaq tend to dominate the headlines. But every day, millions of equity trades are made off the stock exchanges in what is known as over-the-counter trading. What is OTC trading? OTC trading generally refers to any trading that takes place off an exchange. A host of financial products trade OTC, including stocks, bonds, currency, and various derivatives. It's a massive part of the global financial market, with OTC trading in certain types of financial products account for billions of dollars in trades daily. OTC trading in equities can occur for stocks that are listed on an exchange, generally referred to as exchange-listed stocks, and stocks that aren't listed on any exchange, generally referred to as unlisted equities or OTC equities. Exchange-listed stocks may be traded either on a stock exchange or OTC. In contrast, unlisted equities only trade OTC. OTC trading for both exchange-listed stocks and OTC equities can occur through a variety of off-exchange execution venues, including alternative trading systems and broker-dealers acting as wholesalers. Yeah, I said there's a few moving parts. If you're lost here, reread this. When can an exchange-listed stock trade OTC? Exchange-listed stocks trade in the OTC market for a variety of reasons. For example, when an institutional investor is making a large trade, think thousands of shares. They sometimes prefer to do this so OTC for the pre-trade anonymity and potential price stability that an OTC venue can provide. So if you're a Bank of America and you're trying to sell 100,000 shares of Walmart, you may do this OTC to someone like Vanguard or Fidelity or Citibank or Goldman. They do this all behind the scene for a couple of reasons. One, if you're trying to move 1 million shares, 100,000 shares, you don't want to see a huge spike move lower or higher in the stock price. So they can set the price and trade it private without either price movements or some type of signaling. What is signaling? If you're trying to acquire a company, you're going to go behind the scene and you're going to do this all OTC. Otherwise, you're going to see this huge increase in volume. Now, here's the problem in terms of trying to monitor that. You have all these moving parts. All this information is supposed to be trackable. And I don't know if OTC information is tracked. The reason being, you have so much OTC activity. How is that reported? And I suspect NASDAQ, SEC, New York Stock Exchange, and a few of the other exchanges all have to compile and distribute that information for public documentation. Institutions and broker-dealers don't necessarily want to publicize their trading strategies. If a large institution or brokerage firm attempted to make a block trade on an exchange, the market might react in such a way that pushes prices in a direction unfavorable to the institution or firm. In other cases, even small trades in exchange-listed stocks might occur through ATSs, single dealer platforms, or wholesalers where the firm believes that it can obtain a better price through these OTC execution venues than on an exchange. Why are certain stocks unlisted? There are a number of reasons why a company's stock might be unlisted. A company must meet exchange requirements for its stock to be traded on an exchange. A number of companies are traded as OTC equities because they're unable to meet exchange listing requirements, such as the threshold for the number of publicly traded shares or the minimum price per share. Usually, that means the company is financially in trouble. Other large companies are traded OTC because they've been delisted from the exchange for failing to continue to meet listing standards. These often include companies seeking bankruptcy protection. ADRs, American Depository Receipts, certificates representing a specified number of shares in a foreign stock might also trade as OTC equities instead of on an exchange. That can include ADRs for large global companies that have determined not to list in the US. Where can I find information about OTC trading? OTC trades in exchange-listed stocks, whether occurring on an ATS or otherwise, must be reported to a FINRA trading reporting facility. There's the answer. Along with trades that occur on the exchanges, OTC trades in exchange-listed stocks reported to a FINRA TFR are published on the consolidated tape, an electronic system that provides real-time data for listed securities. Transactions in OTC equities must be reported to the FINRA OTC reporting facility for real-time public dissemination. That's answer number 2. FINRA also publishes aggregate information about OTC trading activity for both exchange-listed stocks and OTC equities, both for trades occurring through ATSs and outside of ATSs. Additionally, FINRA publishes a variety of information about OTC equity events, such as corporate actions, trading halts, and UPC advisory notifications, among other things. What are the risks of trading in OTC equities? All investing involves risk. But there are some risks specific to trading in OTC equities that investors should keep in mind. Compared to many exchange-listed stocks, OTC equities aren't always liquid, meaning it isn't always easy to buy or sell a particular security. If you're seeking to sell your OTC equities, you might find yourself out of luck because you simply can't find a buyer. Additionally, because OTC equities can be more volatile than listed stock, the price might vary significantly and more often. There's also a huge concern, the spread. You have a bid and you have an ask. You could see a spread where the bid is $1 and the ask is $2. And somebody's making that dollar spread between the two. That's the house. And that is a killer because the costs just are crazy. We don't see much of a spread on highly traded stocks, but take a look at the spread on OTC traded stocks and you're going to be shocked at the cost of trying to sell or buy some of these thinly traded stocks. But perhaps the greatest risk to OTC equity investors is that there are fewer disclosure requirements for many unlisted companies. A company that's listed on a U.S. exchange must follow disclosure rules that require it to file regular reports and financial statements with the U.S. Securities and Exchange Commission. These materials, which are available to the public on the SEC database, are helpful for investors seeking to gain a thorough understanding of a company's performance and financial health. By contrast, an OTC equity investor may or may not be required to file these reports. Some OTC equity issuers do file regular reports with the SEC, like listed companies, and some non-SEC reporting OTC equity issuers might make certain financial information publicly available through other avenues. However, not all do. This means information available to investors about the company could be limited or incomplete. A company might appear to be attractive investment, but judging its performance and prospects can be difficult without seeing details about its earnings, debts, operating expenses, and other critical financial information. The adage, know before you invest, can be hard to live up to when it comes to non-reporting companies in the unlisted market. Before investing in OTC equities, research the company as much as possible and consult with your investment professional. Make sure the investment is suitable for your financial profile. You have the what's known as the pink sheets, and these are the garbage of garbage. These are the shell companies. These are the SPACs. These are the pump and dumps that you're going to read about over and over again on social media. Well, buyer beware. You're going to play the fool's game if you start messing around with the junk on the pink sheets. Comment, let me know what you think about OTC trading. Do you understand it? Are there way too many moving parts? Do you just don't care? Or is this just part of investing? And if you've been successful in trading OTC type investments, I'm talking about non-publicly traded exchange listed stocks, talking about the stuff on pink sheets. Have you been successful? Have you been dogged? You lost a lot of money? Have you been suckered into a pump and dump and are too ashamed to comment on it? Well, comment. Share what happened so other people don't fall into the same trap. Brad Williams, Frugal Finance. Thanks for watching. Hope that helped. See you soon.